the bill, but found their way into the Act. And what we shall be doing in the next hour or so is really sort of just trying to give a very brief overview of the Act. Just a few housekeeping points from our end, which are set out in the screen, is that we would be grateful if you do leave your mic switched off, and that if you have any questions, you can click on the icon in the top right of your screen, and there's a chat over there, and we'll hopefully have time to deal with your questions. The other thing that we'd like to add is that that ideally you leave your videos off, as most of you or all of you actually have them off, because that should improve the speed at which and I think the smooth operation of the platform. Okay, so giving this presentation is myself. My name is Steve Ginjal. I'm a tax partner with the firm. I am joined by Amanda, who's a tax manager, who we both work pretty much on both local and international clients, and with varying varying from income tax to stamp duty and VAT as well. The session is being recorded, so if anybody misses any part of it, then of course we'll be happy to share the recording with you as well, just in case there's something that you're not following. The Budget Implementation Act deals with which changes to three pieces of legislation. I would say it has changes that impact the Income Tax Act and the Income Tax Management Act, so both Income Tax Acts. It also has some changes to stamp duty, and a very minor change to the Value Added Tax Act. The latter two will be covered by Amanda primarily. The income tax legislative changes, there are a variety of them. There are at least 6 or 7. We won't be covering all of them, frankly, because some of them are a little bit very straightforward, or they're just sort of clarifying some language. So I think what we'll be doing is actually focusing on the main points. Amongst the measures that were announced, although I wouldn't say there is any ground-shattering sorts of measures, it's a relatively brief Budget Measures Implementation Act. It does have actually changes, however, that are very far-reaching and have a very, very wide application. For example, the changes to how married couples are to be taxed. So for the first time, for example, we have the legislation catering for married couples which can actually file 2 separate income tax returns, whereas hitherto, since the Income Tax Act was introduced back in 1948, married couples filed one single return. They could go for a separate computation, but still one single return. Now you have the concept of 2 separate returns being filed by a married couple, which of course for anybody who's married potentially has application. There's been some changes as well, tweaking around provisions dealing with taxation of property. I don't think a Budget Measures Implementation Act goes by where there isn't some form of provision that's introduced that has some effect on the transfer of property. One of them being announced actually in the budget speech itself, where there's a 15% rate that applies on the assignments of rights resulting from a promise of sale. But again, even there are some what has been announced as a 15% rate might actually result in a greater degree of tax in very particular circumstances, which Amanda will go through. The changes with respect to stamp duty, again, they involve raising the thresholds in terms of first-time buyers and whatnot to capture a larger amount of value that is subject to duty at lower rates. For example, for individuals that are buying their first home. Indeed, reflecting the rise in prices that we've experienced over the past few years. I mean, obviously, with the measures were announced before any of the pandemic was even on the horizon, and so in a sense, it is the measures are sort of relevant, particularly to the government financial position as it stood, I would say, at the beginning of this year. I mean, one of the things that we shall need to be monitoring closely is with the ongoing support that government is giving, as well as obviously the natural knock-on effect that government finances are going to have in light of what is going on. One would have to see how and in what way and what mechanisms government will be using in order to try and making its books balance. So just with that, I invite Amanda to start taking you through the first few measures.
Good afternoon, everyone, and thank you for joining us. So the first budget measure that I'm going to start off with relates to the assignment of promise of sale agreements. So basically, I would have entered into a promise of sale, a convenio, and I decide to transfer my right on that promise of sale to someone else. So before this budget measure was introduced, any gains or profits that one would have derived from the assignment of a promise of sale would have been deemed to be gains or profits derived from a trade. And thus, it would have been taxed at the rate of 35%. With effect from 1st January 2020, the gains or profits derived from the assignment will still be deemed to be derived from a trade and thus taxed at the rate of 35% after deducting some relating expenses such as brokerage fees. However, this new amendment will not tax the whole gain at 35%, but the first 100,000 of the gain or profit made will be taxed at a final tax rate of 15%, which shall be collected by the notary. The remaining amount will be declared in the income tax return. So let's say I have made a gain of 150,000. The first 100,000 will be taxed at the final tax rate of 15%. The remaining 50,000 will be declared tax return and taxed accordingly at the rate of 35%. Just a small point here, when the assignment contract is signed in front of the notary, a 7% provisional tax payment will apply on the 50,000. But then naturally, the 7% provisional tax will be deducted from the tax due at the tax return stage. The tax return, the Inland Revenue Department, have already issued a guidance on this measure, which one can find on the IRD website. And we are also showing you the link on our screen for ease of reference. We now move on to the second measure. So for the benefit of those not familiar with transfer of properties, very briefly, the general rule is that a transfer of property made after 1st January 2015 is subject to an 8% final withholding tax. However, as always, there are exceptions to the general rule. So, for example, if one would have acquired a property and then sold it within 5 years, the transfer would be subject to a 5% final withholding tax instead of 8%. One of the conditions is that the property acquired does not form part of a project, in the sense that the property was not acquired to be developed into several units. So if I have acquired a property and I have developed it into several units, the 5% will not apply. In the Budget Act, the IRD have introduced new conditions that one has to meet in order to be able to qualify for the 5% final withholding tax on a transfer of property within the 5 years. So with effect from 20th March 2020, the 5% rate shall no longer apply if the transferor at any time during those 5 years would have applied for a development permit. So let's take an example. So let's say I have acquired a field to build a villa for which I require a development permit. If I sell the villa within 5 years, the 5% final withholding tax will not apply because I would have applied for a development permit. But if, on the other hand, I would have acquired the field to build a villa to establish my sole ordinary residence, irrespective as to whether a development permit has been received, the 5% final withholding tax still apply if I would have sold the residence within 5 years. So basically, the main important condition here is that if I have acquired a property which I do not intend to live in to establish my sole ordinary residence, the 5% will not apply. What I want to keep in mind here is that till now, there is an exemption if you transfer a property which you would have owned and occupied for a period of at least 3 years. So here I would assume that the 5% applies if you sell the property within 2 years. Okay, next slide. Steve will go through this now.
Yes. So essentially, this is the measure that I mentioned briefly in the introduction, which is a significant departure, I would say, from what has been one of the fundamental characteristics in the way in which the income tax applies to married couples. So up until now, essentially, a married couple, for want of a better word, has been regarded as one single taxpayer, almost for income tax purposes, where you had a married couple effectively filing one single income tax return. The married couple amongst themselves would need to elect who the responsible spouse is, and essentially the return is filed in the name of the responsible spouse. And then this is actually a bit of a development that had happened in the mid-90s, where previously it was the husband that was automatically the main taxpayer, and the wife would be included in the tax return of the husband. The mid-90s that had been changed, and now we're seeing yet another departure from there, where you have the married couple essentially from basically this basis here with respect to income being earned in 2020, being able to actually do 2 separate returns, provided certain conditions are met. One of the reasons, essentially, as to why this was put forward is because, for example, due to practical issues that the revenue had informed us about that they are facing, such as, for example, where you have a single return that's being filed, you have and the married couple is due a refund. Essentially, the refund is issued in the name of the responsible spouse, and therefore, even though, for example, if that refund is belonging to one of the spouses, resulting as a result of the income of one of the spouses, and in situations where the spouses maintain separate finances, or rather they don't have a system, they don't have a community of equity, but they have a separate patrimony of assets, then that would obviously, in certain cases, create issues for the payment, for being able to cash that check, because it could be issued in the name of one and not the other. There's also other issues around joint and several liability. So where a married couple, the starting point, are jointly and severally liable for the tax liability that the couple have together. So if you have a situation where the income is being earned by one of the spouses without the involvement of the other spouse, we've seen situations, for example, where you'd have, say, the husband that would be the main breadwinner and would be in business and deriving all of the income, and his wife not really being party to where the business and the level of income. And in a particular situation that we had the husband passing away, and the wife effectively saying, "Listen, I have no idea what my husband's business consisted of, and what." How he used to manage our finances, and it turned out that the wife was faced with a very, very hefty tax bill because there were significant shortcomings in the amounts declared by the husband. And again, in that particular situation, the wife was basically jointly and severally liable with her husband for the payment of that tax. So again, over there, what essentially the system is seeking to do is actually to separate the married couple such that each spouse would file a return separately. So in order to elect for this, you need to meet one of two conditions. One possible set of conditions that you meet is that you have both spouses deriving what I would call active income. So effectively income from a trade, business, professional vocation. So you might have one of the spouses or both spouses that are self-employed, and or else that they both have income from employment. So they're both employed. Over there is a slight exclusion to if the employment income is merely derived as a result of holding the office of a director. It isn't immediately clear why this exclusion exists. It's something actually that we find even in the taxation of married couples, particularly when they go for a separate computation. So it's something quite particular, but even in the amendment as introduced by the Budget Measures Implementation Act, we have sort of the mere collection of fees by holder of an office being excluded from the scope of income from employment. The third way is if those spouses have pension income. So as long as you have both spouses having at least one of those types of income, then effectively they can elect to have a separate return. The other way is if the spouses don't have a community of equity. So essentially, the property that they acquire doesn't fall within the system of community of equity, but they have therefore a separate patrimony of assets. And again, I would say perhaps the introduction of the system was perhaps primarily intended for this sort of situation. So where you have spouses that have a separate community of equus, they don't actually have community of equus, and therefore they keep pretty much their finances separate to one another. But of course, it's not just limited to that. It also includes, therefore, when you have both spouses effectively earning income in their own name. So indeed, it is actually quite far-reaching. So what has happened, and if you can go to the next slide, what has happened is that under this system, you have each spouse being able to bring to charge the income that he or she derives in his or her own name. And this applies regardless, what the law says this, it applies regardless of any right which the other spouse may have in respect of that income. Essentially, the way I am reading it, but of course I'll be glad to be corrected by someone else who has a different view, is that if you have a spouse that is deriving employment income that still has a community of equus with his or her other spouse, then despite the fact that legally the other spouse has a right to 50% of that income, or actually owns 50% of that other income, regardless of that legal reality, the income must still be declared in the return of the spouse that is deriving the employment income, his or herself in this case. The same would be in the case of a business. So you might have one of the spouses that is self-employed. If that activity is arising as a result of that spouse who's self-employed, that income must be declared in his or her own income tax return. The situation becomes a little bit less clear when we're speaking about passive types of income. Now, when you have a married couple that is going for a separate computation, essentially when you have passive income, that passive income is attributed to the spouse that has the higher earned income, that has the higher employment income or the higher business income or pension income. So essentially, when you have a married couple that is doing one single return, they will be allocating the passive income to the spouse that earns the higher income. And therefore, that would ensure that that passive income is always taxed at the higher marginal rates. With this system of separating the returns, that is also now something that has changed. So essentially, the income, the passive income that a spouse receives will be taxed in the return to whom that passive income pertains. And therefore, I would imagine, but again, it's not clear, and I'd like there to be some more guidance on this point, but is that if you have, for example, one of the spouses who has shares registered in his or her name, the dividends, for example, coming from those shares would be declared, if they are declared, because in the case of dividends, you don't need to declare them when they're from a Maltese resident company, but if they are declared, they will be declared in the return of the registered shareholder, who would be one of the spouses. In the case, for example, of bank interest, I'll argument. So bank interest, again, where you're not electing for the 15% final tax, that is being derived on a bank account. So if the bank account and the cash that is deposited in that bank account is in the name of one of the spouses, pertains to one of the spouses, then it would be declared by that particular spouse. Similarly, on the opposite side, the law also says that expenses can be deducted by that spouse in whose name the relative receipt is issued. So other than always having to meet the usual conditions for expenses to be deductible, such as, for example, those expenses have to be wholly and exclusively incurred in the production of the income of that spouse, or if we are seeking to claim an expense for expenses that are statutorily deductible in terms of the Income Tax Act. So, for example, the payment of school fees, the payment of LSAs, the payment of various other expenses that the law allows an individual to claim as a deduction. they will be deducted by that spouse in whose name the relative receipt is issued. So if you have, to go back to the example, the situation of school fees, usually when you have school fees, the private school issues a form in the name of one of the spouses, which would essentially and then find its way into the income tax return of the married couple, under whose name the certificate is issued, whether it's the one spouse or the other. It was kind of academic then now. But if we have a married couple that is going to go now for this election where they're going to file separate returns, then the spouse that can claim the deduction is essentially the spouse in whose name that certificate has been issued. So the advice to married couples is to make sure that to be careful in whose name that certificate does get issued. And this principle, we find it going along. So if you, in the case you have trading losses, for example, unabsorbed capital allowances, you always need to look back and see the trading loss arose as a result of who was carrying out that trade that gave rise to the trading loss, one spouse or the other. And depending on the answer to that question, it is that spouse that then can take the trading loss or the unabsorbed capital allowances in his or her particular income tax return. Let's go to the next slide. So essentially, when you and then declare the income in your return effectively, and then at that stage you simply calculate the tax. You have therefore two separate tax bills to pay, two separate payments that will need to be made. Of course, one of the disadvantages of the system would be that if you have a payment on the one hand of one of the spouses and a refund on the other spouse, that payment and that refund cannot be offset against each other, because for all intents and purposes of the legislation, the two are separate taxpayers when this election is made. One of the things that was introduced as a result of this amendment was a kind of an anti-avoidance rule, I would classify it as, which is basically in respect of certain types of passive income. Essentially, the law says that where you have one of the spouses that is deriving rental income, or both of the spouses for that matter, that is deriving rental income, or investment income, both types of income being eligible for the 15% final withholding tax. To date, the application of the 15% final withholding tax has always been elective, right? So if you derive rental income, provided that you meet the relative conditions, you can pay a 15% final withholding tax on the gross rent that you receive. If you are deriving investment income, it's the same. So if you are deriving investment income, you would ask the payer to withhold tax at a final rate of 15%, which would mean that the recipient of that type of income won't be obliged to declare that income anywhere else in the return. What it also means is that the individual might choose not to have the tax being withheld at source, in which case that individual or that taxpayer would be required to declare the income in his or her return, and as a result of which that income will be subject to tax at the marginal rates that apply to that particular individual. So you might have someone who, for all intents and purposes, decides to declare the investment income, who's already paying tax at higher rates at 35%, and would therefore need to pay 35% on that investment income. But generally, if you would request that for the payer not to withhold tax on the investment income at 15%, if your rate of tax is one which falls below the 15% threshold. This way, for example, you might not have any income in your own right, and therefore, or very little income in your own right, and therefore that income, if declared, would still be falling within the tax-free bracket. And therefore, that would mean that you're better off not paying tax or paying a little bit of tax than paying 15% withholding tax in the case of investment income. The same applies to rental income. So, for example, if you have, in the case of rental income, deductible expenses that you can claim against that rental income, you might not choose to withhold tax at 15% on the gross, but rather you will simply declare the profit as calculated for income tax purposes, with say deduction for any interest that you might be paying on a loan for that you borrowed to acquire that property, for the 20% maintenance allowance that, for example, is allowed in terms of income tax legislation, so that you end up paying tax only on the profit that you are left with. And then that as well could mean that even though your tax rate is higher than the 15%, given that the amount of income in respect of which you're paying that tax is lower because of the deductions, then the amount of tax that you pay, despite at a higher rate, is actually less than 15% of the gross. So what this provision does, it says, listen, if you have one of the spouses whose income falls within the tax-free brackets, or rather is less than the tax-free threshold, which stands at around 9,000 euros plus, I believe it's 9,100 plus, then automatically that spouse loses the right to elect out of the final withholding tax system. So automatically any rental income, any investment income being derived by that particular spouse is subject to tax at 15% on gross, okay? And that is intended that there isn't an election that is being made purely for obtaining this tax arbitrage, I would say, so for just obtaining this particular advantage. If, however, you have income, regardless of the rental income and the investment income, that already pushes you into a tax bracket, so you're deriving income of more than, say, 9,100 or whatever the applicable minimum rate is. If you're a parent, it's slightly higher. Parent with dependent children, I should say, is slightly higher. Then you can still continue to elect into the final tax or not. So essentially over there, the legislator is ensuring that you are at least going to be paying 15% tax in any case, because the first bracket that you hit of tax above the 0% would be the 15% bracket. So for sure, you're not going to be abusing from the system and electing for a separate computation purely to end up not paying tax on the investment income and the rental income. This said, it does potentially present a added benefit compared to the system that we have today. So in the system that we have today, as I said earlier, if you have a married couple that goes for a separate computation, this type of income is always allocated to the spouse that has the higher income. Whereas with this system, this type of passive income would be allocated to the spouse to whom that income is considered to belong, keeping aside the issue of community of acquisition and whatever, at least, or in his name, sort of the income is being derived. So if you have one of the spouses that, let's say you have both spouses that are working, that are both deriving employment income in their own right, but one of the spouses' income is significantly lower than that of the other. So you might have, I don't know, the wife deriving income where she's ending up in the 35% bracket, and the husband deriving income where he is falling in the 15% bracket, for argument's sake. Then in that case, there could be an added benefit of going for a separate return. Why? Because under the current system, the passive income of the couple is automatically attributed to the wife, being the higher income, and therefore taxed at 35%. Whereas under this system, if the income can be shown to be being derived in the name of the lower earning income spouse, in this case, in my example, in the case of the husband, then arguably there is some benefit to be obtained from there. One other point that seeks to limit the abuse is that you cannot elect in and out of the system as and when you want. Essentially, if you elect out of the system, then that election remains in place for 5 years at least. So there you might have a year in which you elect to go for separate returns. You might have another year it will be more beneficial to go for one single return and perhaps apply married rates. You cannot be playing around like that. So once you elect into the system once you elect into the system and you elect out of the system, you can go back into the system for at least 5 years. So that is really the situation with the taxation of married couples. One of the things which is not in the slides, but which has consequential effects is, for example, there have been consequential effects to particular provisions in the Income Tax Act that, for example, the application of married rates, right? The couple that elect for separate returns cannot cannot apply then the married rates. They always need to apply the single rates or the parent rates, as the case may be. Okay, so there's a particular consequential amendment that was introduced there. One of the things that was introduced, for example, is an amendment with respect to part-time work. So some years ago, they had introduced a change to the part-time work rules, which essentially allowed the 15% rate that applies to part-time work to be applied by one of the spouses, as long as the other spouse is in full-time employment or is in receipt of a pension or is in full-time education. So in order to apply the 15% rate before, it could only be applied by an individual where he was in full-time employment, in full-time education, or in receipt of a pension. And it only applied to his extra part-time work, so whether it was part-time self-employed or part-time employment. A number of years ago, I think in 2010, they had changed the legislation such that one of the spouses can benefit from the 15% on the strength of the other spouse satisfying those conditions. So essentially, you could have the 15% rate applying to part-time work carried out by the wife, for example, where, say, the husband was in full-time employment. When you go for a separate computation, when you go for a separate return, and therefore you elect into this system, that no longer applies. So in order to get the 15% part-time rate, the spouses cannot rely on one another to satisfy those conditions. They have to satisfy the condition of having full-time employment or being in full-time education or having a pension, deriving a pension, in order then to get the 15% on the part-time work that they might derive in their name. Okay. Do I have any questions till now? No, doesn't seem to be the case. So, of course, if there are any questions, please, I remind you, please feel free to use the chat. Click on the chat icon in the top right of your screen, and please submit the questions. Yes, Christina's asking, how do you elect? The forms, there's going to be forms that will apply. When you elect, the election starts to apply from the start of the year of assessment, starting after the year in which you made your election. Effectively, what this means is that if I elect in basis year 20, it will apply from year of assessment 2021. So for the returns that I file in year of assessment 2021, therefore, with respect to income derived in 2020. There are forms that are yet to be published. Amanda, correct me if I'm wrong. Those forms are not yet available.
Great, Steve. But recently, what I have seen, I'm not sure whether this relates to the separate computation, but there is who has the online, who use the online system. There is a tab in the personal section where I can click on it and do the election there. So. Okay. I saw it on mine, to be honest with you. So I know, presumably, this is available to everyone.
Okay. I wasn't aware of that.
It was under the personal items.
So when you file an electronic income tax return?
Exactly.
Okay. Okay. So, moving on, because I'm also concerned about time, the definition of a company has been amended slightly. Essentially, the definition of a company includes or contemplates the situations where you might have cell companies, okay? And cell companies are primarily used in very particular industries, in two industries in particular. One is the insurance industry, so you have the creation of what we call insurance cell companies, so where you can have a protected cell company being created with it being legally one single person, and then that company can create cells within itself whereby it attributes assets and liabilities to those cells, and those assets and liabilities are ring-fenced from the assets and liabilities situated in other cells or in what we call in the core. Okay. For the purposes of the Income Tax Act, those separate cells, because they represent again a separate patrimony of assets and liabilities, are considered to be companies in their own right. So you although legally you have one company with one single legal personality, the cells within that protected cell company are each considered to be companies in their own right, with their own income tax registration number, having to file separate returns, and what have you. The other instance where cell companies are used is actually with securitization vehicles, so insurance and securitization vehicles. The Companies Act was recently amended such that the concept of cell companies has now been expanded to include situations for rather companies that are involved in the shipping or the aviation industry. So the reason being is that, for example, typically you'd have investment platforms that are set up, or ownership vehicles that are set up, where you will have different aircraft, for example, being owned in separate different companies. And for each aircraft that is bought by a group, they will set up a special purpose vehicle, being a separate company with its own name, with its own C number, and whatnot. The change in the cell companies legislation essentially allows one company to be set up, and therefore separate cells and then being created through which they to own all the different aircraft. The consequential change to the Income Tax Act was, whereas before it specifically referred to insurance cell companies as being treated as separate companies, now it is basically being widened to include any type of cell company or any type of company that has separate cells, where the cells will be considered to be companies in their own right. And this is really to take account of the fact that the concept of cell companies is not something that's remaining limited to insurance or securitization vehicles, but is being applied across certain other industries. The next change is a change to what we refer to as Article 14(1)(h). This is a deduction that has been there for many years. I think it's one of the original deductions. If you look at the 1948 Act, if I remember correctly, it's kind of found there, which provides for a bonus deduction, so to speak, where you have scientific research costs, so effectively research and development costs. That 50% top up, so for every euro that you spend in R&D, you can take a deduction of 150. That has been scrapped. It's been effectively removed. The reason why it's being removed is not because there's been a shift away in terms of policy of not supporting R&D anymore, but rather that there have been new rules that were introduced by way of subsidiary legislation called the patent box regime rules, which essentially allow for, in certain cases, a greater deduction for R&D that's connected with the development of patents or with the development of certain qualifying software. The reason for the introduction of these rules is really as a result of international development. So some people may be aware of the BEPS, the BEPS project that is being driven by the OECD, where there's been an agenda to redefine and redesign certain international tax rules, and one of those areas is actually where you have countries that give beneficial rates or a beneficial tax treatment to R&D activities. And there's a very lengthy report that was published by the OECD, which is also being supported by the European Union, which sort of says what tax benefits should a country give in respect of R&D, and therefore Malta has essentially redesigned its legislation so that its legislation conforms with this recommended framework. The other amendment on 15% on rental income is the contemplation of a rental income of a lower rate of tax instead of the 15% that currently applies on all rental income. Essentially, the legislation allows the publication of reduced rates where you have a private residential long-term lease, and this sort of fits in with the introduction of the Private Residential Leases Act, whereby you have landlords being encouraged to register their rental agreement, but obviously as a result of which act we've seen a greater degree of protection being given to tenants and greater restrictions and greater obligations being imposed on the landlords. And the quid pro quo of that is potentially the introduction of a lower rate of tax, potentially. There's no rules that have been published that provide for these lower rates. It merely contemplates the fact that these lower rates can be published. I have a question here from Anne and Francis Kushkiri. If a wife is employed on a reduced hour basis and has her business registered in a penny, can one elect to have the 15% withholding tax on her employment? Yes, if you have you have one of the spouses that is carrying out part-time work where the other spouse is carrying out full-time work, then typically you can apply the 15% rate on the income derived by the spouse who is carrying out the part-time work. Over there are of course certain limitations that apply, such as, for example, if it applies to the first 10,000 euro of income where it's part-time employment, and 12,000 in the case of part-time self-employment, the remaining amount of income over and above that will be subject to normal rates of tax. But again, this has been there for many years. What the separate return does change is that the wife will lose that right. If there's the wife that is doing out the part-time work, where she was qualifying because her husband is in full-time employment. So that would mean that if they go for a separate return, then essentially the wife, in order to get the 15% on the part-time work, has to be meeting the conditions on her own, which is full-time employment, full-time education, or deriving a pension in her own right. Okay. Yes. Again, another relatively minor change, and again, it's interesting thinking about it. A lot of the changes are actually changes that are touching pieces of legislation that have been there for the last 70 years. So again, Article 14.1a, this is the rule that deals with the deductibility of interest expenses that a person might derive, which essentially allowed that person to claim a deduction against the income that is being acquired through the employment of the borrowing. So essentially the legislation there requires that the interest expense on borrowings of a particular person can only be deducted against income which is being produced from assets or from an activity that those borrowings are directly funding. In 1st January 19, we saw the introduction, again, as a result of international developments and the passage of the European Union's Anti-Tax Avoidance Directive, is the introduction of rules around the deductibility of interest expenses, or rather than interest expenses, I should say borrowing costs, because it's not just interest, but borrowing costs in their wider nature. And essentially what that rule introduces is a capping on the amount of interest expense that a taxpayer can deduct in a particular year. And essentially that capping is set at 30% of that taxpayer's EBITDA, earnings before interest, tax, depreciation and amortization. So insofar that you had deductible interest expenses, there is yet now an additional capping that applies, that you can only claim a deduction for those additional interest expenses as long as those interest expenses do not exceed 30% of your EBITDA, tax-adjusted EBITDA, for the particular year. There are then a number of other rules that apply and exceptions to those rules and exceptions to the exceptions of those rules, which I'm not going to go into today. But essentially one of them is, for example, that you can always take a deduction of up to 3 million of interest expenses. So where you have your interest expenses in a particular year are below the 3 million threshold of a particular company, then you can claim the full amount as deductible. But essentially what this rule now introduces, the amendment to the Income Tax Act, what it's seeking to introduce is possibly relaxing the deductibility of interest expenses as it stood before the interest limitation rule was introduced. So rather than you having to have necessarily an immediate and a direct link, whilst the new change does require you to have that direct link, the scope of the deduction is arguably slightly wider. So for example, rather than the interest expense having been incurred on capital employed in acquiring the income, there is the wording used is that where it is being incurred for the purposes of a person's trade, business, professional vocation, or on capital employed for the purposes of acquiring income rather than in acquiring income. And that might indicate that, for example, certain interest expenses, certain borrowing costs that, for example, might arguably have a capital nature could possibly be claimed as a deduction going forward. What the proviso does allow is for the guidelines to be issued in terms of Article 96.2 that would essentially interpret this provision. And we know, for example, that we know for a fact that there are guidelines that will be published, for example, in respect of the interest limitation rule that was introduced as a result of ETA, the 30% limitation of EBITDA, for example, as to how one interprets it and how one interprets certain parts of the exceptions that will be provided. So certainly here, there is potentially scope for being able to claim as deductible certain borrowing costs, even the use of the word borrowing costs, whereas the previous version made use of the word interest. So certain types of borrowing costs, which hitherto might not have been deductible, which arguably with the introduction of this change might actually become deductible, given the fact that we now have to contend with the interest limitation rule that has been introduced as a result of it. Just very, very briefly, because I realize we're tight for time, is two minor changes. Taxation of overtime. This was something that was announced in the last budget, where there's going to be a 15% that applies on work being derived from abroad employment, where you are deriving overtime wages. We have yet to see the rules around that being published, but effectively we have over there an enabling provision that will allow more detailed rules to be published, and which have yet to be published, so we need to continue monitoring this position. The last amendment is really an amendment to the Income Tax Management Act, and that basically applies for where you have transfers of shares in a property company or transfers of shares in a property partnership. Again, over there, essentially what the change does, and this is not something that was announced in the budget and wasn't in the bill, was that it provides for when you transfer those types of assets, that rather than paying provisional tax of 7%, you can possibly be required to pay a significantly higher degree of provisional tax. As the wording is, it's provisional tax. So whatever, it's really a cash flow point. So whatever tax you would pay on the transfer of those shares, you will then be entitled to a credit of that tax when you declare the amount of the actual gain in your income tax return. And that's how the legislation stands today, that any extra provisional tax that you might have paid is available for a refund. What, however, the amendment does say is that it will be determined in rules that will be prescribed. So I would suspect that one might see some changes coming into the capital gains rules, so subsidiary legislation, or the property on tax on transfer rules. I might suspect, to see how this is going to be applied in reality. Again, it's one of those open-ended amendments where for sure there'll be more detailed legislation being published, hopefully not to the too distant future. And with that, I pass back on to Amanda.
Thank you, Steve. So very quickly, as Steve has mentioned at the beginning, there have been some amendments to the Duty on Documents and Transfers Act as well. The first one, this has already been there, but there was a minor change. So basically, with effect from 15th October 2019, when one acquired an immovable property, 3.5% stamp duty rate applies on the first 175,000. Before this change, the 3.5% applied on the first 150,000. The second amendment, this relates to property which is acquired causa mortis by the heir. Again, this has already been there, but there has been another minor change. So what is this provision? This provision basically states that when an heir inherits a property which consists of a dwelling house, and the dwelling house was the ordinary residence of the deceased parent, or the deceased parent was the owner of that property, and the heir itself was already living in that dwelling house, if we meet these conditions, then the heir has to pay, the heir who is living in that house has to pay stamp duty, but not the stamp duty is not a 5%. It's not a charge of 5% straight on the value of the property, but in a progressive manner. So basically, there will be no duty on the first 35,000. At 3.5% will apply if the value of the property exceeds 35, but does not exceed 175,000. Previously, this was 150,000. And then if the value of the property is higher than 175,000, the normal tax rate of 5% will apply. So basically here the change was in the values. So previously it was 150,000, now we have 175,000. Another change we have noted in the Budget Act is that if the causa mortis deed is made after 1 year, the interest rate of 8%, which was usually charged by RD, has been removed. And we understand that this is going to be replaced by another rate, which is going to be determined by the Inland Revenue Department. To our knowledge, we haven't seen any guidelines so far on this rate. The next amendment, this is an interesting one. This relates to transfer of partnership interests. So I'm going to start off by giving you some background so that you can understand why this amendment has been introduced. So in principle, a transfer of partnership interests and transfer of shares are subject to stamp duty. However, the Duty on Documents and Transfers Act contemplates for certain exemptions, which exemptions are only applicable if we transfer shares. These exemptions were never introduced to transfer of partnership interest. So if I have to take an example, let's say we had a reorganization within the same group of companies, and such reorganization will not be subject to stamp duty. Why? Because we have these exemptions in the Duty on Documents and Transfers Act, which exempts such transfers. However, if we had a transfer by an individual of a partnership interest, let's say an exchange of interest in another partnership, that would have been subject to stamp duty because the stamp duty, the Duty on Documents and Transfers Act does not contemplate for any exemptions with regards to partnerships. So therefore, we had an inconsistency between the stamp duty rules regulating the transfer of shares and the transfer of partnership interest. So with effect from 28 June 2019, the Budget Act have introduced provisions to align the transfer of partnership interest with those of the securities. So so now we have duty value shifting provisions, for example. We have reorganization reliefs provisions, which are similar to the exemptions that we had for transfer of shares. We also were going to see exemptions on stamp duty covering acquisitions and disposals of interest in partnerships. Sorry about that. Okay. The last amendment, which regards duty. So basically, the Budget Act. The Budget Act has introduced an amendment concerning interest and penalties. Before this amendment, the Inland Revenue Department used to impose 100% penalty if the duty declared was lower than one should have declared. So this was quite an expensive one. So we understand that the 100% penalty is now being removed and is being replaced by an additional duty equivalent to 20% of the amount of duty assessed by the Commissioner for Revenue. Okay, with regards to VAT, there has been only one amendment. So basically, currently, if we submit our VAT return electronically, we have a 7-day extension to submit the VAT return and payment. However, as from 20th March 2020, we are allowed to submit the VAT return electronically within the 7-day extension without payment. and there shall not be a penalty for late submission. However, there is interest for late payment, obviously because you wouldn't have paid the VAT payment due. That is all from our end. Steve, I'm not sure whether you had any further comments.
I mean, of course, this is intended to give a very, very brief overview. So, of course, if there are questions or whatever, we remain available to take them up offline. So, with that, I thank everybody for joining. I hope that you have a great weekend, obviously the current circumstances, and most importantly, that you are all safe and healthy. So keep well. Thank you.
Thank you.